Perfect. Okay. So officially, morning everyone. Thanks a lot for joining. So just give me a thumbs up if you can see the screen. Um, you can put in yes in the chat also. Okay, perfect. Awesome. Okay. So yeah, please unmute yourself, everybody. Okay, perfect. Let's get started. So I think today's session is all about global investing. It's a big topic of late, and there has been the reason why I'm doing this webinar is there has been so many requests from our investor community about how to invest globally, etc., and all that. So that's sort of like why we are doing this webinar. This little bit of an information overload, but I think we will try to peel the onion as we go along today. Okay. So most of you know me, but in case if you don't, so I'm Kiran. I run Soho Wealth, which is a wealth management firm based out of Hyderabad. I spent a couple of years in New York, worked at Wall Street, did strategy consulting in New York, and then came back, now back in India. Very bullish on the India growth story. So we do mutual funds, PMS, PMS advisory, bunch of stuff there, right? So that's in a nutshell about me. In fact, I was fortunate to work for President Obama in Ethiopia at one point of time. So I would say fortunate there. So yeah, that's in a nutshell about me. So just to get started with, I would love to also keep this, session more and more interactive. So first question first, there is nothing like a right or wrong answer there, right? But why global? Okay. So what we will do today is, so first why you should start looking into global allocation, global portfolio there. And then we will build the base on like, what are the avenues for you. And then the most important part, what I will also discuss is the tax implications, right? I think the most, important aspect, how do you send money, how do you make money, and how do you bring it back in case if you want to bring it back. Okay, so these are the three main agenda items for us today. Okay, so just to set the context, why global, right? So why should you invest global? Okay, so just to set the context, we are very bullish on India growth story. Our primary market will be India. Okay, when I mean by primary market, right? Say if you have, say, out of your whole 100% portfolio allocation, say if you're investing 50% into equities, out of 50%, 40% or 45% will be still in the Indian market. Okay. But what we would suggest is, always look into the diversification, like, that 5 to 10% has to be in the global market. Okay. We will, understand the reasons why in just a bit. Okay. So starting with, the first question first, right? Don't Google. Okay. Throw your answers on the, chat box. Uh, does anyone know what is the value of rupee in 1947, when India became independent? Just throw it in the chat box there, or you feel free to. Don't Google though, just less than one. Interesting. Any other answers? USD one. No, 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 no. Indian rupee. What is the value of Indian rupee? Okay, you are saying 1 rupee. Okay, fine. 1 rupee, 1 rupee. No, that's fine. Okay, perfect. Okay, the value of 1 rupee in 1947 is 3.3. Okay, one US dollar equals to 3 rupees, actually 3.3 rupees or something. Okay, now exactly a decade ago, what is the value of 1 rupee? Any guesses? 2016. I'll talk to that, right? So about in 2016, the value is something around 60. Yeah, is around 63 rupees. Okay. Now, what is the value of rupee as of today, right? The value of rupee as of today is somewhere close to 91. Okay. So from 3 rupees, the value of, rupee has become to 90 rupees. Okay. What does it mean? That means rupee, the value of rupee is eroding, right? So for example, like if you, let me take this instance there, right? So for example, like, if you have 1 lakh rupees, in 1947, 1 lakh divided by 3 is how much? That is like close to 30,000, right? You would have got $30,000. Okay. But as of today, if you have 1 lakh, rupees, 1 lakh divided by 90 is how much? I think it's close to thousand, $1,200, right? So, yeah, it's like what? 1,500, $1,600, right? That's like, 1 lakh value, right? So from $33,000 that you had, in 1947, the value has fallen down to 1,500 rupees. You're getting the point, right? So the value is eroding at a very faster pace. That means the rupee value is eroding. Okay. So what I'm primarily trying to say there is the let me take this quick example, right? So if you want to, if you are earning in rupees and if you want to spend in dollars, okay, you have to protect your cap money and you have to keep your money in dollars also. That is the whole concept of global investing, okay, in a nutshell. So, for example, the cost of US education has gone up, right? So in 2005, it's like, $21,000. Now it is $48,000. But you see the difference there, right? In 2005, so for example, if you are sending the kid to US education, you would have spent only 10 lakhs. Okay. But, of course, that there was almost sort of a double there. That means the 10 lakhs should have become 20 lakhs. But instead of 20 lakhs, the value has become, 41 lakhs. You're seeing the number there, right? So if you want to spend money outside, on vacation or education, etc., and all, the value is getting eroded. The rupee value is getting eroded. So that is the number one reason. If you see here, right, used INR rate, that's how it is, right? So whatever money you are earning in rupees, you need to deploy some money in the dollar, assets also, and you need to convert your rupees into dollars and keep it there because the value of rupees falling. Okay, clear until here? Any questions? Okay, cool. So that's like the first set of the context there, right? So the value of rupees falling over a period of time, there is 3 to 5% erosion. So if you're aiming for international travel, if you're aiming for international kids education, like, you need to, apart from the Indian rupee assets, you need to have the dollar assets also in your portfolio. Okay. Now, the second point is why global investing, right? So last year, if you take Nifty has generated almost nil returns. I'm sure most of you, are there in the some of the groups that I run, etc. and all. But whereas in I think last start of last year, I kept telling South Korea will do really well. South Korea will do really well last year. Okay, you know how much return South Korea has generated? The chart is in front of you. South Korea has literally generated 70% return last year. Okay, so even if India is not generating any return, right? India means, the index is not generating any return. The South Korea has generated 70% return. So why should we lose that opportunity of not making money there? Simple point, right? It's, when we are talking about globalization, etc. and all, that means, our finances also has to be global, right? Why can't we participate and make money there? Why should we only, get stuck to only one country? Okay. So that's another reason. So the opportunity to make money outside, participate in the global portfolio is also one of the reason why you should start investing globally. Okay. I think everyone knows this company, right? Everyone knows this. I don't think there is anyone like, in this group who doesn't know this company, right? So Nvidia has its like, darling time in the last just 2 years, literally, right? And it generated like almost close to 400% return. Okay. Whether you take Alphabet, Google, especially these Nvidias of the world, recently Micron, SanDisk, and of late, whatever happened with Venezuela, there is like a lot of defense companies, oil companies, everyone is, doing really, really well. Okay. They're like literally giving 20%, 30%, 40% returns. Guys, please mute yourself. Oh, okay. Most of these companies are generating 20, 30, 40%, 50% returns, right? So why should not we participate in the game? Why should only the US investors have all the fun? Why can't Indian investors have all the fun and make money there, right? That way you're making money in dollars. Okay. So what I'm trying to say that is setting the context here. The first thing is, It's not a it's not a sort of an option, but it is a necessity for you to have some assets in global, some assets in dollars, okay, because of the erosion in the rupee value. The second thing is, since there are so many companies out there, there are so many indexes out there for you to participate in the game and make money, you should also, start looking into global investing, per se, right? The number three, I won't go too much into this, but let me talk this slide a little bit, and then we will, jump into, how to start investing, right? So primarily, with due respect, of course, we are bullish on India story, etc., and all that stuff. But most of the, AI innovation, there is so much of innovation that is been happening. Most of that innovation is happening outside. Okay, whether we accept it or not, unfortunately, that's a fact. Okay, if you see to the right, there is so much, that is shaping us. Whether uh, sorry, whether it is 3D printing, whether it is, rockets, robots, precision therapies, etc. There is so many new technologies that are coming up, which means there are, like, so many new companies. There's so many new verticals for you to participate in the game, right? So unfortunately, those are not available for us in India. Okay, so this is also one of the reason why you have to start looking into global investing per se, right? Because participate in that game, eventually make money, right? And then of course, keep the money in dollars there. So let me take a quick pause here, before we dive into how to invest, So were you able to understand the setting the context why you should start looking into, why global investing should be part of your portfolio, Any questions? Feel free to unmute, and then, like, we'll take 1 to 2 minute pause, and then we'll move to how to start investing. What are the avenues available for Indians?
Hi, Kiran. It's Kavita here.
Yeah, yeah. Hey.
My question is like, okay, you are saying that we can save in dollars, but ultimately when we get it to India, it will become again a rupee. So how are we compensating there?
Sure. See, like, there are certain funds, I'll talk to that. That's a very good question, right? There are certain schemes where you can actually take the money out and you can keep the money out there. You need not even bring it back to India. Okay. So my whole point is, even if you are bringing back to India, Kavita Garu, for example, that, today rupee is at 90 rupees, right? So now you're sending the money at 90 rupees outside. You're earning it in dollars, to be frank. Your, the dollar thing is growing. Okay, let me take this quick example, right? Might be okay, just give me a second. I'll just do this quick calculation in front of you, so that you will understand it, right? So, for example, right, you are sending $100,000 today, okay, at the rate of 90 rupees, right? So you are closely sending 1,000, $100, okay, let's say approximately, okay. So over a period of say 3 to 5 years, this money, this dollar amount has become, let's presume this has become $3,000 for you, okay. Now, there is a rupee depreciation that is happening at 3 to 5% every year. That's what we discussed at the start, right?
Yeah.
So that means presume that, like, rupee will, depreciate to 110 rupees or 115. Let's say 120 rupees, right? By the time you want to bring the money back, this 3,000 times 120. I'm correct, right?
Yeah.
3,60,000. So your 1 lakh has become 3,60,000, right? Just because, there is appreciation, like, your dollar value has appreciated and rupee has depreciated. But again, the 1 lakh to become 360, thousand in rupee terms is, is not that easy, right? To be frank, there's so much of stuff. But having said that, this is one part of the answer. The other part of the answer is, there are certain funds where you can actually take the money out and you can keep the money out as well. You need not actually repatriate back. You can actually use it for, the tourism purposes, or for your education purposes outside also. So that's like, the another advantage that you have. But you got the logic, right? 90 rupees you are sending, and then you are bringing it back to 120 rupees. You have an advantage. You have a rupee, so dollar that is getting depreciated. the sort of the assets also getting, appreciated there. Make
Yeah.
sense?
Yeah. Very
Cool.
much. Very much.
Yeah.
Right.
Cool. So now how to invest, right? So now, unfortunately, I know I'm recording this session, but I think I'll make this statement. Unfortunately, see, India is a developing country, right? So the number one challenge with RBI, the number one problem with RBI, and what RBI always tries to do with Indians is taking the money out of the country. Okay, RBI always has this problem. Okay, because India is a developing country, right? External remittances are always a problem. See, if everyone starts taking money outside and if they will never bring it back, and like if say if you're taking the money out, that means you're buying dollars, right? So the external portfolio of RBI will generally come down. Okay, so point being, what I'm trying to say there is like RBI will always restrict the external remittances that is going out of the country. Okay, so let's look into like how to invest. There are a couple of avenues for retail investors, and also for the high net worth and family offices there. Um, so the first option is typically the mutual fund route, especially. Okay, within mutual fund route, there are three types of mutual funds, at this point of time, that you can explore. Okay, so one is called feeder funds. What does it mean? So primarily, also let me take a step back and then also explain you how investing happens, in any, especially in any asset class, especially in mutual funds or anything, right? Always there are two types of investing, right? One is active investing. Active investing का मतलब क्या है? You create a portfolio of stocks and you actively manage that portfolio. Okay, so that is what PMS is all about, AAF is all about, PMS advisory is all about, etc., and all that, right? So mutual funds is also part of active investing because they actively keep churning the portfolio. Okay, the other set of investing is called passive investing. What is passive investing? Passive investing is investing into ETFs. Okay, so for example, Nifty 50 is an index, Nifty 100 is an index, Nifty X 100 is an index, Bank Nifty is an index, silver के लिए silver bees is an index. Okay, so generally what happens is there you don't actively manage, right? So Nifty 50 has a 50 bunch of stocks. Whenever these stocks move, that Nifty 50 index will move. So similarly, which will be reflected in your Nifty 50 ETF. Okay. So these are two types of main, investing in the investing world, which is active investing and passive investing. As an investor, you will pay money to the fund manager to actively manage those funds. Okay. The expense ratio that you pay to the mutual funds is just because of that. The PMS, the management fee that you pay to the fund manager is just because of that, because they're actively managing. The passive funds, the so-called ETFs are not actively managed. Okay. What is there to manage? Nothing is there to manage, right? You're just reflecting the index there and then you are letting it ride on its own. Okay. Now, from the mutual fund perspective, for you to invest into mutual funds, as an Indian investor, most of the mutual funds actually rely on the passive route, not on the active route. Okay. You're getting my point, right? The reason being, I know I don't think mutual fund has it's not about the skill set. I think it's more to do with the bandwidth to research about companies, which will do well, which will not do well, etc., and all that, and actively manage the portfolio. Okay. And also, I will tell you one more thing. When I talk about the taxes there, why they don't actively manage. Okay. So most of the mutual funds, investment route that is available for you as an Indian to invest into global portfolio is only through passive funds. If you see this, Motilal Oswal Nasdaq 100 fund of fund. Okay. Similarly, Franklin US Opportunities Fund. Okay. US Technology Equity Fund of Fund. Okay. So they don't actively manage the funds. They invest, instead into ETFs or the funds that are out there. Okay. Got the first point there. So that's about feeder funds. The second is, there are funds like Parag Parikh, etc. and all, they pick up some companies, which are actively managed, but their active, thing has come down recently. Earlier, they used to have 35% international exposure. Now it has come down to only 10%. Okay. So that is like, the second route for you. I'll talk about the mutual funds. I'll show you the route and I'll tell you what are the loopholes there. The third one that I mentioned also before is the ETFs listed in India. For example, this Motilal Oswal, Nasdaq ETF, etc. and all. So these are again very popular funds where you can actually explore the opportunities to invest into the global market. Okay. So primarily it's a Nasdaq ETF. Whenever the Nasdaq moves, this Nasdaq ETF moves, and then you make money. Okay. So that is how the underlying proposition is. As a retail investor, if you are a retail investor, these are the best options for you. But there is a challenge. What is the challenge? I think the challenge is this. Okay. I think a few minutes ago I mentioned about, there is in RBI, cap on overseas investments, and RBI came out very strongly, especially in 2022. Now, what they have said was, all the mutual funds put together, I think India has 42 AMCs, and recently, I think 4 recently got added. So even if you take around 45 AMCs, right? All the mutual fund AMCs put together, they can't invest more than $7 billion outside into the global funds or global ETFs, etc. You're getting the point, right? They're saying even though Indian investor wants to invest, I'm not letting you invest because I have a problem. That is RBI's problem. Okay. RBI is like, I don't want the money to go out. Okay. Unfortunately, we cannot do anything there. We can't literally do, nothing there. It is RBI policy, and I don't think RBI is changing this policy anytime soon. I think we had some internal discussions, with RBI, and they're not at all keen to relax this now. Okay, mutual funds are fighting, but it is what it is. Now, now, this actually limits, by the way, already all the mutual funds are at peak cap, right? All the mutual funds put together has already invested $7 billion. Okay. So, so then what, how do you invest? So how do you primarily invest? I think you can take a screenshot, might be I'll share this, sheet with you. There are few funds that open up once in so generally what happens is this, right? So there is this $7 billion cap, but there might be some investors who might be redeeming it, right? So might be that $7 billion has come down to $6.8 billion. So there is $0.2 billion of subscription open. Sometimes the mutual funds open for subscription. Okay. As of today, I think as of January 2026, these are some of the schemes that are open for subscription. Okay. Because of that, the redemption, right? Like, primarily some investors have cashed it out, the new investors come in. Okay. But this can change at any point of time, in the sense, right? This can change in a day's time, and they can say, okay, we are no longer accepting the applications because we have hit the limit there. Okay. That is unfortunately the problem, with mutual funds, especially for the retail investors. Even though we have options available, we cannot invest because of the RBI policy of $7 billion cap. Okay. So unfortunately, that's the problem. Any questions here to start with before I go to Gift City and other stuff? Exchange rates, don't worry about that. And the exchange rates, when you I think Tarkeshwar Rao, like exchange rates, you can always negotiate with the banker. Exchange rate is a very tiny portion of, like, whenever you transact the money, and like it's not that you are doing it on a day-to-day basis, right? So exchange rates is not a bigger problem in the global transaction, if you ask me. Okay, cool guys. Now let me move on.
Kiran, I have a question. Is this limit also includes currency, cryptocurrency?
No, crypto you cannot actually do. I'll come to that in a bit. Okay. Uh, so no, this is purely mutual funds. That's it, right? Now I think before going into that, right? So how much as an individual you can invest into mutual funds is As an individual, you can invest up to $250,000, in a financial year. Okay. So ideally $500,000 in a what I mean to say, the calendar year, because our financial year starts from, like, April to March. So ideally you can send $250,000 on March 31st, and you can send $250,000 on April 1st. So $500,000 you can actually send outside in a calendar year. This is per pan. So if you're a family of four, you can actually move around close to $2 million outside. Okay, so that's the LRS route, that has been given by the RBI. Please be noted, if you're sending more than 10 lakhs, so for example, like, so $500,000 is how much, times like 90. So now it applies to close to, like, 4.5 CR, right? The problem again there is, it's not a problem. I think there is all, like, limitations RBI puts. More than 10 lakhs you are sending outside, after the 10 lakhs you have to pay 20% TDS. Okay, don't worry, that will stay in your income tax account, and you can actually claim it back when you are filing your ITR, in the next financial year. But, like, you have to pay 20% TDS. Please be noted of that, okay, whenever you are sending abroad. This is the LRS scheme primarily, right? uh, Now, I'll come to this in a bit, but, like, I wanted to focus more on the direct investing route. So far you're good, right? As a retail investor, one option for you is mutual funds, but unfortunately, not all mutual funds accept the subscription, even if you get it at a higher price. Okay, so those are the limitations with the mutual funds at this point of time. But if you want to buy and keep it for a longer period of time, you can keep exploring that option there, right? Now, second aspect is direct investing. See, in fact, Vested Finance is run by Vyram. I'm meeting him this month in Hyderabad. He's a good friend. IND Money, Interactive Brokers, so these are some of the options for you to open a direct brokerage account, and then I'll actually show you the, yeah, direct brokerage account, and you can actually buy stocks, directly using this brokerage account. Okay, but the number one, again, the problem that is out there, especially with these sort of the stuff is, there is a little bit of transaction charges, that you have to incur. So, for example, like, approximately these are the charges. It keeps varying, etc. and all. But these are the charges, and you might have to, bear these. I think to someone's point of exchange rate, right? I think this is where the exchange rate really comes into picture, because what happens is, even if you send $100, or even if you send $5,000, I think you have to pay a certain amount of $50 or $100, as a fee to the banker for you to transfer the money outside, right? So you need to negotiate with your banker, very sort of, strongly, to cut down on the exchange rate, or get a good exchange rate. Primarily that's what I would say. So yeah, second one is direct investing. So these are some of the famous platforms for now. No reco there, but you can keep exploring, and then you can start investing directly if you want, through some of these platforms there. Okay, primarily for for the Indian investors there at the moment. Now, Now I want to focus more on the Gift City part. Now what has happened was, fortunately, how many of you know Gift City? Perfect. No, that's fine. So Gift City is like a foreign jurisdiction within an India, space. Uh, uh, Primarily, how Gift City operates is, so it acts like a Singapore or a Mauritius jurisdiction within India. Okay, so that's how Gift City was born, and Gift City is being worked out. Okay, so uh, primarily, what is happening is, Gift City is allowing, lot of funds, especially from India, to set up their strategies there, to set up their entities there. And then from there, you can actually invest into, outside of India. Okay. So primarily what they're trying to do is, they're easing the process for Indians, for Indians to go and invest abroad. Okay. Within Gift City, I would focus on three aspects. One is retail funds. This is primarily for retail investors, who wanted to invest abroad. Okay. And then there is a PMS strategy. The minimum ticket size there is $75,000. And there is a third one, which is a AIF, which is like, similar to what AIFs in India has, where the minimum ticket size is 1 CR. Here, the minimum ticket size is $150,000. Okay. So I'll go through like, one by one, at this point of time. So primarily, if you see, I think DSP has created a strategy, especially where within the Gift City, if you're a retail investor, $5,000, you can invest into that particular fund, DSP Global Fund. So 40% they will invest in US, 32% in Europe, and balance in Japan and China. Okay, so that is how their allocation will be. So this is going back to the previous point that I mentioned, right? Korea has gone up, right? There is NVIDIAs of the world. How do you participate in the game and how do you, make money? Okay. So I think this is one fund where they are trying to diversify across, multiple geographies there. So the most important part, I think here, let me talk about, taxation there, right? I think, okay. So especially Gift City, right? Most of the Gift City funds, I don't know how many of right? There are two levels of taxation at any point of time. One is, so for example, what happens in the mutual funds is, mutual funds generally give you the returns, you pay the taxes, etc. and all. Whereas in the case of PMS, in case of the category 3, uh, the taxation is at the fund level. Okay. I don't know. Okay, let me put it this way, right? Okay, I think I'll take this quick, English plain example there. So, for example, I'm a fund manager, right? You have given me $100,000, okay, as a fund manager to me. Okay, what I will do is, I will have my own strategies, etc., and all that. And then say, imagine I made this $100,000 into $200,000, maybe say after 3-4 years. Okay, now I have to give it back to the investors, and the profit there is $100,000, right? You gave me 100, I gave you 100, so you have to pay tax on that $100,000. Generally, what happens is the taxes are of two different types, especially in the investment world. One is, I give back all the $200,000 to you as an investor, and I will say, you figure out, right? You pay the taxes as per your tax slab rate, etc., 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 and all that stuff. Okay, so that's like one way of doing it. The another way of doing it is out of that $100,000, as a fund manager, I will pay the taxes, whether it is 20%, 30%, 40%. So, for example, like, the taxes are like, 40%. I will pay off $40,000 as a tax and I will give you the rest of the $60,000 to you. Okay. When I give the rest of the $60,000 to you, you don't pay any tax because the tax is at the fund level, at my level. Okay. So based on the structure of the fund, the taxes do vary. Okay. So not every structure, has, same thing. For example, like Cat 3 funds in India are taxed at the fund level. That is, fund pays the tax. For example, like, VC funds, PE funds, generally they pay back to the investors and the investors pay the tax, so there are like, multiple modes there. Okay. In Gift City, what happens is, understand this clearly. Gift City, the tax is at the fund level. Okay. So you're giving me the money. I, as a fund, I'm paying the tax. Okay. So how are the tax structures done? That means that, to be frank, you need not be bothered or worried about, whether you have to pay the tax or not, because I'm already taking care of the tax there. The tax is, now Gift City, what it has defined is there are, again, you have two types of taxes, right? Short-term gains tax and long-term capital gains tax. If you are, buying any stock and if you're selling it less than 2 years, you have to pay 42.7% tax. When I mean by you, the fund has to pay 42.7% tax. Okay. But in case, so for example, right, now going back to my example, you have given me $100,000. Out of that, what I have done is I have put 25,000 on Apple, 25 in Google, 25 in Facebook, and 25,000 in NVIDIA. Okay. Now, if I'm selling, say Apple that $25,000 in less than 2 years, so for example, even if that $25,000 has become $50,000, I have to pay almost 42.7% tax. Like, that means like close to $12,500. I have to pay it as a tax. Okay. You're getting my point, right? So primarily, what I'm trying to say there is all these funds are designed with a long-term view and perspective. So I am buying this Apple with the goal that I'm holding this for about next 2, 3, 4, 5 years. That's it. I'm not selling it less than 2 years. Okay. If I'm selling it less than 2 years, I'm paying the tax, which is nonsense. But in case if I am holding the same Apple and if I am selling it after 2 years, I'm paying only generally the tax is 12.5, and with surcharge and other stuff, which will come down to like close to 15%. That's fine. Man lo ki, right, 15% tax chilling. Okay. You're getting it right. Now all these taxes are taken care by the funds itself in GIFT City. As an investor, you are investing, that's it. And invest with a long-term view, and then you are making money after 2, 3, 4 years. They will take care of all the taxes, etc., 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 and all that stuff. And then you will get the money back, and you need not pay any tax. That makes sense here, especially on the taxation. Am I clear? Any questions to start with? Here. Any questions? Feel free to unmute, ask. Oh, cool. Now, what are the options for you? In case if you want to invest abroad, primarily at this point of time, mutual fund route, you can still explore, if you have some subscription, but it is highly unlikely that you will be able to get any subscription there. But in case if you are a retail investor, if you have $5,000, you can explore these funds. PPFAS is Parag Parikh. I think Parag Parikh has very good reputation of international investing, and I think they have been doing really well. So what Parag Parikh does is, they put 90%. So those are the strategies there, right? You need not worry too much bothered about that. But there are a little bit of pros for Parag Parikh because there is a lower fee of 0.4%, 0.5%, etc., and all that stuff, right? But the only okay, now let me differentiate between DSP and Parag Parikh here a little bit. If you see the cons here, right? I think going back to my previous point, DSP is more of an active fund, right? So they will identify the stocks, to my previous example of Apple, Nvidia, Alphabet, Google, and then they will invest and they will forget about that. But whereas Parag Parikh is investing more into ETFs, but ETFs also you make hell a lot of money, to be frank. There is nothing wrong in it. But that is why if you see the fees there, that is why the fees is less because it's ETF, it's passive, they are not actively managing. So if they are not actively managing, why should they take money from you, right? They should not take. So that is how the strategies differ. You can actually pick and choose which one you wanted to, and then you can start investing into it, right? Now, recently, couple of weeks ago, Edelweiss has launched this Edelweiss Greater China Fund. This is pure China fund, by the way. And what they have been doing is, one second, sorry. Sorry. So they're getting an exposure to China, Taiwan, and Hong Kong. The only problem is, I think it's a single country risk, unlike DSP, where, you have a global portfolio there. But in case if you believe that, China is a country to be in, you can actually go and invest into this particular fund. Okay. This is all available for retail investors. $5,000 is nothing these days, to be frank. And I think you can start exploring, you can deploy some capital and leave it and then see how it will perform there, right? If you need any further questions on this fund and how to invest, etc., and all, more than happy to chat anytime. Now, let me go through the PMS strategies. So there are a couple of funds who are doing PMS strategies here. Again, there are three fund houses: Philip Capital, Marcellus, and Parag Parikh. Here also, if you see, Philip Capital is only investing in ETFs, by the way. Marcellus is, doing some sort of an active investing. Parag Parikh again, right, here they will be doing more of active investing, in the PMS strategy. But here the minimum ticket size is, at least $75,000 for you. Okay, not less. The another one is the AIF, which is a $150,000 product. Here I think I again don't quote me or whatever, right, but I'm personally liking more of Ionic, what Ionic has been doing. I think they have a very good team, not a reco, but I think they're doing a lot of good work in terms of researching the companies, so, and they're investing across a lot of global markets at this point of time, US, China, Taiwan, Korea. They have a bunch of exposure there. Um, and yeah, they're focusing more on mid-tier IT companies and other stuff there, right? So that's what Ionic is has been doing. Mirai is another one, but again, like, this is again ETF based investing, right? It's not like they're actively investing into stocks, but they're picking up ETFs which are doing really well and investing into ETFs. Okay. So these are primarily the three main options that you have, depending on where you fall into, depending on your risk appetite, depending on your capital allocation. You can actually, choose, which one to go after, whether you are a retail guy or a PMS guy, or a AF guy, if you have the capital there, right? And yeah, there are a couple of other funds here. Baroda PNBS, Marcellus is again doing it. Now, Rational is another fund which is quite interesting. They've been focusing only and only on gold and silver. They're actually putting money only into gold and silver miners. Okay, nothing else. So that's quite an interesting strategy there as well. Okay, so these are like, the PMS retail strategies out there. Okay, I spoke about taxes. Yeah, I think that's sort of pretty much it. Primarily, okay, let me go through this slide once, since I've gone through this. Okay, so here is sort of the exact summary, right? So whatever the discussion that I had in the last couple of minutes. So primarily, you have mutual fund investing, um, and you have ETFs investing abroad, you have gift city funds, gift city PMS, you have direct US stocks, which you can invest through. So these are the sort of the options, right? Now let me talk a little bit about US estate tax, right? How many of you know US estate tax as per se? Perfect. So, before that, what I will do is, I will talk about Schedule FA, and then, like, I will talk about US estate tax. So, what is Schedule FA? Schedule FA is whenever you are filing your income tax every year, you need to mention or talk about your foreign assets. Okay. I think there are some forms, ITR 3, 4, whatever. I think income tax professions know that better, but primarily, you need to declare whatever foreign assets that you have, while you're filing your income tax. Sorry. Whether you are making money, whether you are generating revenue, making money there or not, whether it is sitting idle, you need to at least, mention that in your income tax. What happens is, sometimes US officials and Indian officials keep exchanging the, investor records, and if you don't file the income, the revenue, what I mean to say, the income avenues of the, sorry, foreign income sources, or, foreign income there, these people say, it's black money, you're doing, blah, 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 and all that stuff. And unfortunately, the penalties are very high. Okay. So the Schedule FA is one area where you need to keep in track. In case if you're investing, you need to report in your income tax every year. Okay. If you are doing a global investment. It's easy. I think your CS can take care of, it's not like a rocket science, etc. and all. Okay. Now coming to US estate tax, what US estate tax is all about is, for example, like, if you invest in US, and unfortunately, if there is a demise, okay, say for example, like, a person X invested and a person X, had a demise. Now the if that person X is holding, more than $60,000, okay, um, unfortunately, the US estate tax comes into picture. Okay, so for example, like, there is an investor X. he has invested $100,000 in United States and he passed away, he or she passed away. And whether it is husband, son, daughter, or whatever, whoever is claiming that, okay, hey, I have access to these particular assets. Since it is above $60,000, what happens is US actually deducts close to, I will recheck on the exact number, but I think it is close to 40% or 30% of, the money gets deducted, that's called the inheritance estate tax. And then they will give only the rest of the money to you. Okay. So primarily, ideally, you're just giving the money to the US government, nothing else, right? No, just for the sake of it. So there are so many debates. Unfortunately, US estate tax is seen in a very negative light. I think there has been so many debates about India to pass about US Indian estate tax because nothing has come out. Every budget people are scared if India will bring the Indian estate tax because like why should we pay tax our hard-earned money to give it to our kids or like next kith and kin, right? So that's like super nonsense. But anyway, US has this policy. If it is above $60,000, you have to pay the tax in case the investor is demised, right? So that is unfortunately the problem. That one thing that you have to keep a track of if you're investing. It happens in the rarest of the rarest cases. It's not an tick box for you to think through whether you should invest or what you should invest into, etc. and all, right? So that's in a nutshell. Okay, that's pretty much it. What I wanted to cover. I think yeah, almost like 50 minutes. To take questions, and I think I have a couple of questions there. With central government changes in the future gift city. See, I don't think so, sir. Tarkeshwar Rao. See, the gift city is becoming too big to fail, at this point of time. See, initially I had very apprehensions on a personal note, when the gift city got started. But last year, I went to Ahmedabad, spent a couple of days there, met with almost all the regulators, had a very detailed discussions. Gift City is like, not too big to fail, don't worry. Even if Congress comes into picture, they cannot say, okay, hey, sorry, let's grab gift, I don't think that will happen. I think people have moved on from there. Yeah. Yeah. I think we can open the floor to questions. If you have any questions, we'll talk. But you got the gist, right? How to invest, what are the options available for you? Was it helpful?
Yes, sir.
Guys, feel free to ask as many questions as possible. You can feel free to unmute, ask. See,
Hey,
we had to
Kiran.
put like in a lot of work, in collating all this data and all. Yeah, go ahead. Someone is asking.
Hey, this is Vamsi Kiran. So, is the $7 billion outward remittance from the MFs also applicable to this limit to the gift city funds or?
No, that's a beauty.
Uh,
So it's like, like Gift City is like an international structure in Indian jurisdiction, right? So like, even if you are, so for example, like if there is a Gift City, okay, let me put it this way, right? Um, so for example, like, if you're investing Motilal Nasdaq ETF, from your bank account, okay, that is considered more of a domestic transaction. Okay. You're
okay.
getting my point. But if the same, in case tomorrow, if Motilal ETF, Nasdaq, is, available in Gift City, that is considered a international transaction. So what happens is your LRS limits will kick in. You getting my point, right?
Got it.
So Gift City is structured in such a way that like it is acting like a Mauritius or Singapore jurisdiction, not like an Indian jurisdiction. So this is sort of to benefit. So primary goal of India is to attract NRIs, to put money into dollar terms, because of this rupee depreciation, etc. and all. But I think they are also allowing Indians to invest abroad, through this structure. So that $7 billion, etc., won't come into picture, especially from the gift. Yeah.
Okay. Thanks, Kiran.
Sir, is that $7 billion restricted to US or all the global countries?
Global.
Okay.
Global. Yeah. So you can invest in US, South Korea, Japan, whatever, but the money that is going out has to be max $7 billion. That's it. And to be frank, see, now I'm sure most of you has mutual funds, right? More everyone these days are investing in mutual funds. That limit got hit long ago, to be frank, and to be frank, even if, tomorrow RBI says, I'm actually revising the limit from 7 billion to $50 billion, I'm pretty much sure, I'm telling you, I'm pretty much sure that $50 billion will be met even in less than in the next 2 years. Because उतना demand है, right? Especially, for people to, invest abroad or be participative in those assets, actually.
So, is there any direct options to invest in Japan markets or Hong Kong markets?
Japan, Hong Kong, I think you can actually look into, um,
Especially Hong Kong.
just give me 1 second, See, Hong Kong at this point of time, I think the best option for you, you can start looking into that Edelweiss fund, that you have at this point of time, the China fund. I
Yeah.
showed you that, right?
Yes, sir. But I think there are certain limits like 5,000 minimum investment.
It's 5,000 minimum, unfortunately. I think, let me share this. Check out this ICICI Prudential Passive Multi-Asset Fund. I'll type it here, wait. Passive multi-asset.
So, are there any options like IND money? Like IND money used to help us to invest in US stocks directly. So, is there anything like to invest in Hong Kong markets directly?
Unfortunately, India is not allowing it. That's unfortunately the problem. Last year, we know that, South Korean market will go well, but we were not able to participate. What can we
Exactly.
do? Okay. You can see this one ICICI Prudential Passive Multi-Asset Fund. Now, what happens there is, so again, it invests in Japan, China, and Latin America. I'm not giving you the exact right answer of, Hong Kong, but it has an exposure to, Chinese ETF, Japanese ETF, and Latin American ETFs. And I think 1 year CAGR, I think it is somewhere around close to 20%. You can start looking into that. But if you want Hong Kong exposure at this point of time, the only option is Edelweiss, nothing else. Yeah, it's a $5,000 product, but it is what it is.
Yeah. Thanks.
Hi, Kiran.
Hey,
Raju here. I have a couple of questions. The first
sure.
one, if a resident Indian is investing into these gift city funds, the taxation is same as the mutual fund taxation, right? Short-term 20% and long-term 12.5%.
Correct. Here, no. So let me correct you a little bit. So in the gift city funds, the taxation is at the fund level. You are not getting involved. So the fund has to manage it, to be frank. That's what I mentioned before. So less than 2 years, in case if the fund is selling any company there, they have to pay 42% tax. Okay, but it's a headache of the fund, not yours. Okay, if they are selling more greater than 24 months, which is 2 years, the LTCG is the same, 12.5%. But add surcharge, there is surcharge and cess, that gets added also. There are a lot of hidden costs, and I'm telling you, no one tells you that. So Manloki, right, you will get 14.95, 15% tax, so post the tax, which is paid by the fund, you will get the rest of the money. Once you get the rest of the money, etc., and all, you need not pay any tax. As an investor, you will not be paying any tax there.
So is it the case with all the gift city funds?
Yes.
Okay, but we keep hearing that, let's say, if somebody from Middle East, like countries having zero tax, like Dubai, Kuwait, and countries like that, if they invest in the gift city funds, they have a benefit of zero taxation. If that
See,
is,
that good question. So Gift City has two structures primarily, right? One is inbound and one is outbound. Okay.
yeah.
Here we are talking about outbound. Okay. So to be frank, the gift main focus at this point of time is more of inbound. मेरे को, how can we get more money into India has been the primary focus. Okay. Now, your instance, what you are talking is a Dubai, resident or an NRI or a Dubai investor coming and investing into gift city funds where the funds invest into Indian market. You're getting my point? If
Inbound. Yeah.
they're like, when they are repatriating back, and I think they have to pay only the TDS there, and they don't pay any tax in their respective country because Dubai is 0% tax. But there is a TDS component that they have to pay, mutual funds has that. Okay. That is more of an inbound. Okay. Some are coming and investing into Indian market and taking the money back. But this is the opposite that we are talking. In this case, Indians are investing outside and bringing the money back. So in this case, in the case of outbound, this is the tax structure.
Oh, thanks, Kiran. And another question. So, are there any gift city funds currently allowing investors to do KYC completely online? I think it is completely physical now, right? None of the funds are able to do it online.
No. DSP does it online. Ping me offline. More than happy to chat. Actually, yeah, I'll help you.
Sure. Yeah. Thank you.
Yeah. Anything else? Good question, Maya. I keep writing about finance, which, follow the channel if you're not following me. Any questions? I think we can take 1, 2 questions and we can wrap up. It's 1 hour.